Welcome out to another Trading Justice podcast. I'm here with my brother Matt. This is Mark. We're the Justice Brothers from TackleTrading.com. Going to talk about tell of two timeframes. You know, we've used a lot of words, Matt, recently. Difficult, complex, right? You know, challenging, right? We're finding, you know, we need to freaking get the Google and, you know, the thesaurus out there to say, okay, give me a synonym for difficult, to find different ways to describe. But we're going to talk about and kind of educate why that's the case. You and I, Matt, have been very bullish on this podcast for a very long period of time. And, you know, but there are times to sit back and be like, all right, this is a little more challenging. There, another word. I want to find like 8 words to describe it. But before we dive into that, before I even welcome you, Matt, I'm going to just dominate this opening minute of the podcast. You want to talk about tackle trading? My brother Matt is going to be teaching the Coaches Show the next couple of weeks, talking about our very well-received Tackle 25 list, a list of covered call excellent fundamental candidates that is just one of the small little perks you get for being a pro member of Tackle Trading. It's an amazing community. It grows every day. Just lots of good stuff. Tackle 25, Matt. And now I'll bring you in. It's just such a fabulous thing that you've created for our little community. Talk about the class and how you doing, bro.
Yeah, for the pros out there, we are definitely going to be spending the next couple of coaches shows talking about the Tackle 25, going through the watch list, explaining the scoring system, and really talking about the companies that were added new. Obviously, because we have a lot of ongoing conversations on a lot of our companies on the Tackle 25. But yeah, we had a great webinar from last week. You can still check that out. Hit the link in the description, no doubt about that. But if you're interested in getting some detailed conversations on the Tackle 25 stocks, specifically on the list, that's what we're going to be doing in the Coaches Show with the pro members over the next couple weeks. So click that button in the description, become a free sign up for a free trial, and come hang out with me in the Coaches Show.
You know, you want me to read off the 134 similar words for complex that Google just popped up?
Oh, yes. I would like to hear a couple of them describe the current short-term neutrality against intermediate.
My favorite one is naughty.
Naughty?
Knotty, like, you know, intricate, complicated, naughty. Yeah. That was my favorite of the Google
naughty.
Synonym.
The market is being
the
naughty.
Market's not, but it's naughty. I like it because
rally. So apparently we were naughty this previous year. That makes some sense. Now, I would describe it as a short-term neutral trend in the middle of an ABC cycle against a longer-term uptrend. But who's going to disagree with Google here?
But that's what it is, man. Like, you know, one of the things, and you know, in the, you know, when we use words like complex or whatever word it is, right? You know, I think it's important to understand why traders that have been around the market for 10, 15, 20 years, right? You know, use those type of words, right? It's just not out of fear.
Because we know what an easy environment looks like. And this isn't it. And so however you want to describe it, I have described it as a difficult environment because technically speaking, it is a difficult environment. You have multiple time frames that have different probabilities from a trending perspective right now. You have to work that out, quite frankly. And so it's described that way, challenging or difficult, or you'll often hear it be, you know, called volatile or something along those lines when traders are describing the current environment, because we know what an easy environment looks like. An easy environment that has a very easy to understand united theme from a fundamental or an economic or a geopolitical perspective, easy technical conversations where you're talking about short-term uptrend, intermediate uptrend, primary uptrend. Those are easy environments. This is not an easy environment, because if it was, everybody would just pick up stock right now and just you know, enjoy the next couple months of price appreciation. The ultimate question right now is, and quite frankly, and I think this is a very important question, is do we have a leg down, or is this the ending of the pullback or corrective phase? And I do think describing the market, even though it's base neutrality right now in the S&P 500, I would describe the market as a correction. I know it's not technically from a definitional perspective that way on ours.
And you and I both hate these. Well, the market is down 20%, it's a bear market, or the market is down 10%, it's a credit.
That kind of defensives have been slaughtered. 80% of the market is underneath not only shorter duration, but intermediate duration moving averages. The market itself has not is neutral because the S&P 500, the broad collection of everything in the market, is neutral right now. But Mark, we also have seen multiple examples post-pandemic where the market maintains some degree of bullish structure, but it's only been driven by 5, 6, 7, 8 stocks. And that becomes a very difficult environment when you only have a select stocks that are carrying the entire market. And so ultimately, when you're looking at the market right now, and again, just going back to the labeling of it as difficult, yes, it is difficult.
It's naughty.
Or naughty, or complicated, or volatile, or uncertain, or whatever word you want to use to describe it. I wouldn't disagree. I wouldn't argue with it. What I will say, though, is that out of these difficult moments do represent opportunity. And those opportunities happen as we see the patterns develop and the time frames start to get realigned. And so when you're talking about the tale of two time frames here, you're really talking about the difference between the daily chart right now and the weekly chart. And so when you're looking at trending analysis in general, a trend comes to a conclusion when it no longer has a higher level of resistance. That occurred a week and a half ago. A trend no longer is a trend once you violate a support level and no longer have a higher low. That happened on Fed Day in mid-December. Since that moment in time, we have been trying to figure out what the next trend is. And the technical conversation has actually been very consistent. We called for the bearish retracement, we got it. We called for the double bottom, we got it. We're basically calling for the most probable outcomes from a technical perspective just in our live programming. Other people might describe it a different way, but we called for a bearish retracement when it got overextended, we got it. We got for the double bottom, we got it. Now the ultimate question is, do we see the conclusion of the technical story here? And what I mean by that, Mark, I know Elliott Wave gets dumped on by traders in 2025. I would say that is ridiculous because a lot of what they believe in is based on Elliott Wave theory, even if they categorize or talk about it in a different light from what it was 100 years ago. But at the end of the day, Elliott Wave theory talks about and teaches about trending analysis. What are the patterns and the waves that occur within an existing trend? And at the end of a trend, you go through an ABC cycle. And in that ABC cycle, you're basically talking about the corrective phase of the marketplace. And when you're looking at the ABC cycle right now, the ultimate question is, have we seen the conclusion of that, or are we going to see another leg down? I've been saying that for a week and a half because the data hasn't changed in that week and a half. And so ultimately, do we hold 580? Then we're done. We're ready to get back into the impulse wave and a breakout. Or are we going to see that violation of 580 and see something down around that 200-day moving average? So there's questions right now in the market that can only be answered with time and price action. The debates you and I have, the conversations traders have, those are awesome. They get us prepared. But at the end of the day, we need to see certain things here. And in the newsletter for the last 3 weeks, I've been talking about the specific things we need to see. And we've started to see those things. Now it's a matter of, can we get a conclusion to that story? Can we get a breakout of the 20-period moving average on the daily chart? Can that also confirm on the weekly chart? And so and I know I'm kind of going long-winded on this technical conversation. I'll finish my point very quickly. The tale of two timeframes is very simple to understand. Right now, we're going through neutral patterns and neutral trends in the broad market right this very second, over the course of the last week and a half, over the course of the last couple months, when you're looking at the S&P 500 itself. That is a head and shoulders formation. When you have the left shoulder Then you have a slowing momentum head, where you get a slowing momentum from a trending perspective. And then when you breach the support level on Fed day, that was the ending of the trend, and the birth of the ABC cycle was the moment we had that bearish retracement that also triggered into the right shoulder of the head and shoulders formation. We're at that far right side of the pattern development here. And so this pattern has been developing for the last month and a half. I know it's been exhausting. I know it's been frustrating. I know it's been difficult. I know it's been naughty, if you will say. But at the end of the day, I do think you can start to expect a conclusion to this saga that we have been going on recently, because the price action is most likely going to either, one, confirm above the weekly trend, which is still a bullish trend with a pullback. You could get above 593, for example. Mark, that's back to being a bullish conversation on the weekly chart. So I do think it's again coming to a conclusion here. And but again, I don't know which one. Like, I would love to say, hey, listen, let's just go ahead and pick up a whole bunch of good value, great opportunity, cyclical stocks. But at the end of the day, I still think you need a little bit of time here to kind of determine what the next move in the market is.
All right, I'm going to give you 3 reasons why, bullish reasons, why this is going to work out for the bulls, and then lead into my naughty, cautious, what's the variable for me? One of the things that I look from the technical, because I allow, on the formation, on the daily formation, I let you do the heavy lifting. I literally use tackle trading as a member of the community. Be like, hey, listen, I got great technicians that are going to do that. I look for, like precision bounces off my moving averages.
Yeah.
Because and this is, one of these, like, the poker tell, right, is like, how much of this is real, right? In the sense of there's volatility. Oh my gosh, the intraday downward price.
How much of the hypothetical concern for next year that is causing this? I don't think a lot of that is real.
And so, and volatility has a tendency of like showing its hand at moving average levels.
Yeah.
And there are a couple of things. If I go to the monthly chart, and you don't need to show this, but it's on the 5 EMA, we bounced almost to the penny at one point on the 5 EMA. And so what I'm looking for, because daily moving averages in these volatile conditions can get cut through on butter, because they tend to be trendy, right? Daily moving averages, great trending indicators, but when things get volatile, they're less predictable on that volatility. But pretty clean bounce to the penny on the height of volatility on the 5 EMA. This, when you look back, historically, when this happens, it usually works out for the bulls. Yeah. And then one thing we have been keying in on,
just real quick, just, two out of the last 3 off the 20 weekly held firm.
Yeah, and that was where I was going to go to next. I was very curious because I was there paying attention to this late last week. When you had about a volatility, I believe it was Thursday, and intraday chart collapsing, right? Heavy pressure. Oh my gosh, bears in control. And we came down to that 20 weekly on the SPY, right? And I'm like, all right. And I was watching the intraday chart, and I was like, okay, what you gonna do here? It stayed below it for like 40 seconds.
Yeah, it was very, very short lived.
So not like literally like 40 seconds. Like stayed below it, and the market rallied the rest of the week, rallied the rest of the Thursday session, covered over most of the losses, and then rallied all day on Friday. And at the height of volatility, when bears, you had algorithmic programs come in and say, no, I'm going to buy this bounce. And there was no opposition to buying the bounce. That lets me know, at least for that day, there was no real fear, genuine fear, right? Because they got bounced really quick. And the third reason I'll make a case, just from the things, RSP looks like a chart that tends to, on a lot of other charts I've looked at, when you look at the daily chart here, it looks like a chart that has precluded bottoming formations more often than not. Right now, it's not universal that that's the way this play out. There's huge variable. We're going to talk about it with yields here in a second. But when you In Mountain Dew markets, when algos want to sell, they sell. I mean, look at RSP for what? Like 16 straight trading
The Dow
sessions.
had a historical downward pressure price. Not in terms of like percentage move down in that time
but
frame,
consecutive days.
but the consecutive days down.
This is one thing we have to accept as traders. Algos have gotten smarter, more sophisticated. They know how to push the boundaries.
It's going to become more and more and more.
And so, Matt, how many times in the last 6-9 months have we seen the most oversold conditions, the most overbought conditions? You know, these extremes, like record-setting extremes.
In the past, you had to wait for 3 months of downward pressure and price to get this type of opportunity on the downside.
So when they stop selling and they start to stick support levels, that has led to upward movement more often than not in recent years. And so, you know, there's my you know, kind of the observations in the last week that I've had.
I certainly would agree with you on all three fronts. I mean, when you're talking about those longer term duration moving averages, you had some pretty clean precision bounces on the S&P 500. I think on the actual weekly chart on the S&P, I mean, you're anchoring against all moving averages right now. It's the same thing on the daily chart. Moving averages are extremely important. I love your RSP call out because the S&P is shielding the damage that has occurred in the marketplace. And this is a very similar conversation, if you remember, back to 2023, where, you know, we were talking about bull markets, but the bull markets were led by AI stocks and NVIDIA and Google and Microsoft and, you know, so on and so forth. And it wasn't even into the Palantirs yet. It wasn't into the C3.coms. It wasn't into the, you know, the build out wasn't outside of just the semiconductors and the big stocks out there. And in that environment, Mark, you had environments where we talked about the differences between the S&P and the RSP quite a bit, because the RSP became a much better understanding of the broad market health. I think you can rinse and repeat that today. I think the RSP is showing far more consistently with what is actually transpiring across different sectors, different industries in the market than what we're seeing on the SPY right now, which is being held up. Ultimately, where I see the market reversals and kind of where my head's at is on those RSP type names, those cyclical type names. Energy, for example, had a really fantastic week coming off the low point. Now you're talking about a deeper bearish retracement that could certainly work out in terms of a reversal. And so, yeah, I think you can see much more clearer on RSPs showing the consolidation after a sell-off than what the complicated environment of what we're seeing on the SPY is. And so RSP here, you got a little bit of slowing momentum. You got a double bottom. That's what you have right now. To complete that storyline, you have to have the buyer step in and carry a bid. And there is this you first mentality right now. And
that mentality is big out there right now. We
should embrace that you first mentality right now, because everybody is saying, yeah, we all see the value opportunity coming from the low point in cyclical. We all see the certain opportunities on stocks we, you know, want to pick up from a little bit of a, you know, different time frame than just a short-term trade. But everybody's like, yeah, but you first. And, you know, it's kind of like when I was in high school, and me and my friends would go up to Joe's Valley. You know Joe's Valley, right? Up there, that beautiful lake and mountain region down in Orangeville, Utah. And we'd go up to Joe's Valley, and there's this about 35-foot cliff in the air, and you jump and you get into the lake. It's scary as all get out, right? And I remember as a senior in high school, I'd never jumped off the top ledge, and we were all just sitting there going, "You first." And why was there that mentality? Because there's risk involved, right? And you want to make sure that if something bad is going to happen, it's going to happen to your buddy and not you. So you go first. And so what happened, I ended up going first, unfortunately, because my buddy Kelly threw my amazing dolphin hat into the water. Yes, I've been wearing a dolphin hat ever since high school. And I had to jump in and save my dolphin hat. But the same philosophy happens in the market when there's a perception of risk. there's a you first mentality, right? And we want to make sure that we see somebody else in the market go first. And then you're like, okay, they didn't die financially. And so, yeah, let's go. Let's dip our toe in a little bit. There's that you first mentality here. And I'm willing to play the you first game because we're still talking about the development of the pattern at the low point. A double bottom is not a reversal, Mark. A double bottom has the exact same probability scale as in a reversal formation as it does in a continuation. You have zero clue as of right this very second, as we are recording this podcast on Saturday, 2 days before the market opens, that you are going to get that upward movement in price. And so ultimately, we just can't see our buddy jump into the lake to make sure, that they're willing to jump. We need to make sure that they're safe when they land. And so that's the concept of confirmation. I say it all the time. Jesse Livermore said it 100 years ago. Confirmation is your insurance that you're right on your projection. So if you make the bull case and you have these three really compelling arguments, right? The moving average precision test is a very, very good bull part of the analysis. Seeing the value opportunities come from the low point on cyclical areas that RSP represents, absolutely start seeing the double bottom. You still got to see confirmation. You still got to see that dose of confirmation. And what that is when you're talking about a reversal formation, which we're tracking on RSP right now, is you got to see a breakout of the pivot point in the bearish retracement, which is currently at 178. And so you got the 20 period moving average at 179. You got the pivot point at 178. The current price is 176. Mark, by Tuesday, we could get resolution to this conversation. That's why I'm talking about it so intently from a technical perspective, whereas recent history, I've just kind of been painting the overall environment, because we're kind of getting to the point where decisions need to be made by the market, and whether or not we're going to see that breakout and see that opportunity confirm on the top side, or if we get that another leg down. Now, one point on this, if we do see a leg down in the market, I want to see if you agree with me on this. If we do see a leg down in the market, I don't believe that leg down is going to be led by defensive and cyclical components.
1000% agree.
I feel like they've already had their correction, and now they're just working off volatility. And
if we do get a leg down,
it's led by tech and aggressive.
It's led by tech and aggressive.
Because they were the ones that held up during the yield conversation.
Because this is what happens in bearish conditions, which I don't believe. I would not describe these, what's happened to tech so far in bearish conditions, right?
No, either would I.
In cyclicals, absolutely. Like, I 100%. Like how you just said that at the start. It's like, listen, but correction's already here, right?
Yeah. People are talking about whether or not the market's going to correct. I'm like, what are you guys talking about?
But people go hide in things that show strength, which tends to be tech.
Well, and quite frankly, they also get lazy by just looking at the S&P, because that's what we were all taught to do for decades. And that's not the 100% God honest truth of the market any longer. Not when you're,
if you do not look at our,
again, by the way,
we made this pivot to tackle trading months and months and months and months ago.
It was a year ago.
Yeah. Like you have to incorporate RSP into market analysis, or else you're just deceiving.
Unless you do a lot of detailed sector analysis, that you have to incorporate RSP into the analysis, because the S&P will shield in certain conditions, and we're in one of those right now.
So there are, like, when I look, one of the things that we say, and this is a truism, is that cash flow tends to get in the door first.
Oh, absolutely.
And patterns like XLF, patterns like RSP are already, for how I do things, cash flow worthy for me. I love when we get stability of the sell-off. The only reason I am being more hesitant, and I'll go search, is yields in the dollar. Because if we do have a leg down, those charts are likely responsible, and those charts are feeling very, very frisky. I think
like comms. I think you could throw comms into the same conversation on that. Like comms and finance look very similar to one another. Both of them are just dealing with normal pullback scenarios against momentum uptrends, quite frankly. And so I would throw comms into that mix. I still think comms is one of the better looking sectors right now.
But when I go to the technical charts and I look at the dollar, when I look at something like TLT that it feels like it's setting up for a breakdown, these charts are worrisome. I look at TLT, I'm like, that's taking a pause, ready for the next breakdown, which means yields, those long-term yields.
Bonds have been in a bear market for months.
And so like, and there's a point, and this is just, when you hear traders that have been around for a long time, and they mention yields and they're mentioning dollar a lot, it's not that they're living out of fear, they're living out of experience, right? Where they have seen these factors, these type of charts that when they crack, take lots, and not just, and we're talking risk assets in general, and there tend to be.
Would you agree with this? I don't believe we were talking about the difference between easy markets and difficult markets, right?
Yes.
Easy markets are markets there. You can throw a dart at the Wall Street Journal and probably pick a winner, right?
Yeah.
You can throw a dart at your FinViz scan and probably pick a winner regardless of the sector. You have multiple sectors in aggressive, defensive, cyclical, all humming maybe in different patterns, but all bullish uptrends. You have short-term uptrends, intermediate uptrends. Everybody's talking about how easy, those are easy markets. This is not one of those. And so the point I'm going to make right now, Mark, and I want to see if you agree with that, is I don't believe we will get an easy market as long as we're fighting the dollar.
Nope, you won't.
Okay.
Deal with it.
So if there's one anchor you have in the market, yeah, there are complicated technical conversations in the S&P right now, especially in comparison to RSP, but it's not complicated on the dollar right now. Short-term bullish uptrend, intermediate bullish uptrend. You just broke out of a high base. You got to see this trend break.
Yeah, no. And you and I last week in our predictions both think the dollar is going to be much lower in 2025, right? But that doesn't.
Don't think the worst case scenarios are going to play out the way the yield and the dollars are pricing in.
But that don't mean the dollar's not going up in the month of January, right?
No, that's not what it means. In fact, in the prediction podcast, I said this. I was very close to calling for a correction in the S&P because I still think we can in the S&P, which would be another leg down in the S&P. That's based on the dollar and yield still going up until we get into the heart of earnings season, which is probably and that's not too far away. We get banks in a week and a half. So it's coming up.
No, and so I like it, and we're going to talk about this a little bit in Stock in the News on Microsoft when we talk in a little bit. I love the case for equities, especially from a cash flow standpoint in 2025. I like the technical short-term case. I like the fact that I do believe Trump will do whatever he can to elevate the stock market because he uses it as a scorecard. I mean,
he scoreboards with stock market.
He scoreboards with the stock market. You want the president to scoreboard the stock market.
I wish Biden would have scoreboarded with the stock market more.
Janet Yellen did.
And I'm not saying this from a political perspective. I'm just saying, as a bull, I like political cheerleaders. That's all I'm saying.
It makes things easier, right? Yeah. It makes things easier.
You don't want a president to fight you on the market.
I think the valuation sans a few maybe Mag 7 darlings are
points a little elevated.
Because that is what I think is lost in the whole valuation. When bears come out and say, "Oh, valuations," take out a few stocks and valuations ain't expensive at all.
I know. If you're going to make the valuation argument, I think it's beyond lazy to make a valuation argument on the broad market. If you're going to make a valuation argument, go make it in technology itself. Go make it in cross comparison of communication companies. Not every PE ratio should be treated the same on a tech stock versus utility stock versus a consumer defensive stock. And so valuation is in comparison to its peers, and a food-based company does not have a peer with a tech company.
And so this is what we're going to be doing in program, and we're going to talk about this in the podcast in coming weeks. What is the dollar doing? What are yields doing? What are the developing technical patterns? And then it will cross over to things like gold. I really like what gold has done the last 2 weeks. I love it. I increased my cash flow bias at the end of the week after a period of stability. If we start to go up, I will increase that bias. And so this is how I'm approaching individual areas, right? And all right.
Well, before we get into the commodities, can we stay on the dollar real quick?
What a currency guy wants to spend some more time on the dollar. Oh, what a shock! What a
I
shock!
know,
Right?
shocking.
I'm gonna Google some synonyms for shocking while you say whatever you're gonna say.
Go ask your AI buddy data. My question to you is very, very simple. Is the dollar going up solely based on the concern of inflation and yields, or is the dollar going up because it's some other reason out there in your estimation?
Well, I mean, you know me. I spend most of my time analyzing yields, not the dollar itself.
That's why I was asking, because I knew you were on the yield conversation. But is there anything else?
My goodness gracious, bond people are having the most robust theoretical discussions these days, and I'm being serious. It's actually very
give me some. See, this is where I need more of you in this podcast.
All right, Jim Bianco,
bond discussions.
Jim Bianco has been saying yields are going to go up and will continue to go up as long as the Fed keeps talking about cutting rates. Like they're saying that, like, counterintuitive. 100%.
The market's saying you're insane for even embracing a cutting of rate conversation right now.
And we're going to punish you.
We are going to force you to change.
Yes, and we're going to force you to change, because
I could see a little bit of that.
If you are cutting rates in this environment, that is inflationary.
The Fed keeps talking about cutting, bonds keep going up.
And Jim Bianco says that as long as you keep discussing cutting rates, Fed yields are going to go up, because they're going to punish you on the inflation, because it's insane.
Why do you think the Fed is so ambitious about the cutting of rates?
Because the Fed is a child.
I get it, but the data doesn't suggest.
No, the Fed is slow moving. And when they publicly say that this is, and we've seen this all throughout
J. Powell. To me, though, like, this is so stinking.
I know, but they said we're in a cutting cycle, and
it doesn't matter
if we change our mind.
Dependency 48 billion times.
But Matt, we've seen this out of J. Powell his entire time. He starts down a path, and it does not matter what the data says. He is going to continue down that path. What's led to the disastrous inflation.
Past. I love doing this now and then with our rankings in the sectors, because sometimes when you get to an end of a trend, you're going to go, you have an aggressive ranking, but you got to reset the ranking, right? So a lot of times I'll be like, all right, forget the ranking, reset it, look at the current environment, rank as it's fresh. Let's do that with the yield conversation right now. Yes, Mark. They went through the pause. Now they're embracing a cutting cycle. And I don't want to spend time in this podcast teaching the 100-year business cycle according to interest rates. The Fed is simply embracing that. But let's look at it with fresh eyes. You have core inflation has been sticky for not just 3 months. Core inflation has been sticky for 6 months, minimum. You are now starting to see CPI headline inflation getting sticky around the 3% level. PPI unfortunately went up over the last couple months.
And this is all without oil.
Oh, this is before oil's upward movement in price. You're absolutely right. This is, in fact, when you're looking at like earnings forecast right now, the market is like, oil and energy stocks are really, really bad right now, because year over year, oil's been going down. I'm like, you guys are lagging. You're not getting the up to speed information. All right. So you're absolutely right. So inflation's a concern right now from a sticky perspective, not from a, oh my goodness, elevated, but 3% sticky compounded over a 5-year stretch is going to be nasty for everybody. And so we got to finish the job on inflation. And so from an inflationary perspective, the inflationary situation is not screaming for the Fed to cut rates. On the flip side, it's screaming for the Fed to sit on their hands and do nothing. That's what it's
is screaming that.
Screaming.
It is
a 5-alarm fire scream.
It is, what in the hell are you talking about
a child who understands how the inflationary conversation actually works throughout the world?
Announce a pause and say, it's time for us to see how this
markets don't hate pauses. Like J. Powell, PSA, markets usually embrace pauses.
And so there is this and one of my favorite analysts, Jim Carshan, who I adore, retweeted Jim Bianco. This is how I got into it. But there's other factors as well.
Hey, but real quick. So inflation obviously screams pause. Mark, the GDP got elevated in its projections in the SCP last time the Fed met. and we're expecting 3% growth this year. Like, who's at 3% growth? And don't get me wrong, I know people want to buy a home and they want lower interest rates, but from a macroeconomic perspective, at 3% GDP and 3% inflation, that does not scream cutting rates.
Yeah.
In fact, the polar opposite.
Now, other issues impacting things, and these are Janet Yellen shenanigans. Janet Yellen, and I am not a bond expert, but I know more than 99% of people, or 99.9%.
That puts you as a bond expert. It's okay.
Because I don't
go
put
to you to
myself,
listen to bond stuff. So please,
like the elite bond people that are like this, that upper echelon.
Elite bond people probably don't know very much, to be perfectly honest.
Anyways, Janet Yellen had some shenanigans. She did things with the issuance of debt, doing a lot of short-dated debt issuance. Now, she wanted to do this because she wanted yields to go down in an election.
To prop up the market and get yields to go down.
It's one of the many things Janet Yellen did in the election year, not in the best interest of your average American.
Not in the best interest of the American way of life.
This is why I have utmost respect. Janet Yellen knew how to play the game. She knew how to market leverage. She understood markets.
I would never have done what Janet Yellen does, but I have
But I found
it plays it better than anybody.
I mean, she's an evil emperor. She's a horrible, despicable human being, but you have to respect her.
I don't know about horrible, despicable, but
I do. Like, she hurt average people. That's a horrible person. Yet. Anyways,
probably works.
And so Scott Benson, it's going to be very interesting to see, because now you're going to have a lot of debt come on the market. Now, it is very unlikely that Scott
comes in. We're going to get more debt into the market,
like not just a little bit, a metric ton of it. And if you issue that longer dated, that creates, well, you're going to have to entice buyers. This is part of the 2023 run up in yields, is the whole, you're issuing a bunch of debt. What are you going to do about it? Long dated debt, yields is supply and demand. And so that thing, as we head into 2025,
so do you think we're seeing a little bit of Janet shenanigans all year long, finally exploding into the market, and we're all paying for those sins?
Yes, I do.
Is that kind of what you feel?
I think it adds to the volatility. Now, I think, it
makes sense. That makes sense to me.
And so these are, two of the factors I buy the most. And I hear all kinds of things like it's a conspiracy to do this, or, other thoughts. But like, these things make sense to me, right? Markets punishing Fed for.
Is it a conspiracy when you try to figure out what the truth behind price action is?
No,
I wouldn't call that a conspiracy.
Yeah.
But
so there's factors. And so this causes me, how do these factors play out? Because, over the last couple of weeks, we haven't had a lot of data come into the market. We're about to get a lot of, full cycle of data, right? We got Fed minutes this week. We got unemployment data. We got services data. And it's going to be interesting, right? And I have no idea how the dollar and yields are going to respond in the short term. But I do know, and the one thing we talked about this last week, I don't want to hear Tom Lee tell me that they're not a concern until you see them go to 5% or 5.1%. That kind is the worst analysis. It is disrespectful to the people listening to it, because you don't know, right? I do know the correlation on ours.
I said earlier in this podcast, if I had the answer to the Tele2 timeframes, I would just give it. I don't. I have to describe the environment the best way I can. But these are, when you have mixed time frames, they become complicated until they don't.
Now, there are reasons. Now, do we have out of control inflation? No, we don't, right? We have sticky inflation. We have worrisome inflation.
You have sticky inflation, but you also have a really improving economy.
Yeah.
And Mark, that's the second thing I was going to add on the dollar conversation, is because it's been a yield conversation for the most part, but in that yield conversation, Mark, we've had good economic data. And when you're talking about the currency, you can't just put you can't base everything in the comparison economically against zero. You can't say 2% growth is good without some degree of context behind that 2% growth. That's what currencies do. currencies look at the economic value not in terms of a absolute perspective, but they look at the economic value in terms of cross comparisons against other economic systems. And the U.S. economy is simply, quite frankly, kicking everybody's ass right now.
Yeah, and so these charts are complex. They add to the complexity of the situation. Like if RSP, if you were not having a yield conversation, if you were not having a dollar conversation, well, RSP probably wouldn't be where
If we
it's
didn't
at.
have if we weren't having those conversations, we would be having, do you want to chase this next high flying stock that you don't have a belief system in? And so that can be complicated in and of itself as well for a trader. I don't mind the complicated environments because I do believe, and this is kind of my general message of Tackle in the last week or so, coming out of this complicated, volatile environment is going to be a big buying opportunity. Yes. Whether it's currently with confirmation or whether we see another leg down, you don't get these environments all the time where you want to pick up your favorite stock at a lower price. And so I do see it through that lens specifically. But I also think patience is warranted until we get better analysis. The thing about Tom Lee, he never says anything other than I'm right. It's bullish buy. Like that's all he says.
Yeah, and if I hear cash on the sidelines one more time, I'm gonna vomit in my beanie.
There's always cash on the sidelines.
Yeah, there's a lot historically less than there's ever been. So could we please get that nonsense?
Oh, it's the bull. The bulls are still
crowded. You know, so somehow I called you by accident on the phone while we were talking.
You did.
The person calling you on the phone wants to talk about gold. You know,
I checked. I looked at my phone. It was Mark. I'm like, yep. He
I did.
I do right now.
But like, you know, and this is the thing is like, you know, I have positions, right? And so like I have existing positions I'm managing and I'm using technicals in this situation. So I know it's complex. I know, you know, there's things. And so I'm, you know, lower position size and being careful on new things, but I got stuff I'm managing. And then I'm using technicals to say, how should I manage this? And I love volatility. I love the support bill. I like from a casual perspective. I'll be honest. I love,
like you said, cash flows first in the door, right? I mean, I can just tell you, kind of recapping every conversation I had in the Traders Lounge this week was, I feel confident on the cash flow side of the equation, but Delta still needs some work. That was the entire philosophy all week long up until Thursday, up until Thursday when we were all looking at NVIDIA's chart on Thursday before the breakout on Friday. And me and Greg were looking at NVIDIA, and I said, what about cash flow here? And he's like, no, I kind of like NVIDIA. And I was, yep, market order trigger above the 50-period moving average. There's opportunities in every single market, but from a market perspective, I do think patience plays here.
Yeah, absolutely. And so gold, silver, and so we're seeing some encouraging things in different commodity areas. You see in gold, you know, create some consolidation after volatility. That was a calling card in 2024. We saw silver stick a landing on support. You see Bitcoin hovering in a consult. So there's encouraging things that, you know, that cash flow traders and directional traders will continue to monitor that general approach. But I want to talk about crude oil for a second. You know, unless you have anything specific to add on silver.
Gold basically in consolidation right now, pretty benign, honestly. When you're looking at silver, I think silver has a directional bullish opportunity, but I do think a little bit more pattern development is warranted there. But that's something we've been tracking in the lounge, and we're going to continue to track that silver development.
Yeah, but crude oil got interesting really quick after being terribly uninteresting for a very, very long period of time. One of the stronger moves we've seen in a crude oil in a long time. Now you get extended from daily moving averages and so forth. Don't understand the move, really any catalyst behind it, but from a technical position, you and Frank started calling this out in our pro content a couple weeks ago. You're like, technically, this is looking, it kind of forecasts the potential.
Well, it was the increase in support. It was wiki, but the candles were really telling a story here. And you had that increase in support that was really, really consistent. And then a couple days later, both of us were just like, yeah, that thing looks like it wants to run there. And when you're looking at crude oil here, I would not be chasing crude oil after 5 consecutive days up here. But I do think crude oil should, maybe not crude oil, but energy itself needs to be on the radar for secondary pattern development here. Energy stocks have the lowest valuation in the marketplace. They have the lowest forward PE ratio in the marketplace. The biggest problem with energy stocks right now are downward revisions from an earnings perspective, but those downward revisions, which are very normal, don't get too caught up in downward revisions on earnings. That happens every quarter. But those downward revisions are all based on the average price of crude oil being lower right now in the quarter than it was last fourth quarter. So for example, Mark, we've been dealing with like average price of 67, 68. When you were talking last year around this same time frame, average price was 72, 73, 74, 75. You're talking 10, 15, 20% down from where it was last year. And so earnings is obviously going to be concerning out of energy, but now you start seeing that upward movement in price. If it sticks here, energy has an opportunity both on the growth and on the value side. And that's something I always get a little bit interested in. So short-term, deeper bearish retracement, we're going to be looking for that next increase in support or that next high base. But energy, I think, does have to be on the radar based on what we're seeing on crude oil.
You want this on pattern chart because let's not forget the policies towards energy companies. This is a very easy narrative. Are going to be very favorable under the
There's executive orders coming on day one regarding energy.
And so it's a little too wild for my cash flow blood right now because the move's been too strong.
It went up too much.
It went up too much too fast. This is something certainly on my radar. We'll monitor the crude oil. All right, I want to get to a few stocks in the news, Matt, at this point. I believe that the general macro case for bull is in equities is stronger for bulls than it is for bears. And one of the reasons, and you keep emphasizing this, you've made me more bullish in the last 2 years when you talk about AI, and not just from oh my gosh, it's so cool, this big build out, right? It is, you talk about, hey, we're in year 1, we're in year 2 of this multi-year build out.
It's a 7-year build out. We're going into year 3.
And when you shared this, and I missed this news during the week, you had to mention, be sure to mention Microsoft, where they plan to spend $80 billion on AI-enabled data centers in fiscal 2025. Now, one of the things on semiconductor stocks has been CapEx spending. It's going to be down. They've already spent. And then when you see news tidbits like this,
I don't understand where the arguments for negative CapEx is coming from. It's been in the market
but it's prevalent.
Somebody's pushing it and it's not there. These companies keep spending more money and more money and more money. Microsoft's going to allocate $40 billion in the first quarter, for crying out loud.
Yeah, and so this
AI data centers, not anything else. So
the storyline's real. It's a real story. Anything to expand on it, Matt?
No, it's just, once again, that is one of the biggest negatives of the AI technology semiconductor conversation right now is in general, R&D budgets going down out of the Mag 7. What have we seen last quarter in earnings season? Every single Mag 7 component want to spend more money. And I keep telling people, have you guys not lived how semiconductors work? They're going to come out with a new GPU in 6 months from now. And then they're going to come out with a newer one. And then that one's going to be faster. And then I'm just going to throw out to my Wall Street friends out there who keep on crying about CapEx spending. Wait till AGI is officially achieved and we see artificial general intelligence out there. We start seeing a singularity where you start to see a compounding impact on the AI build out because the AI build out is building out itself. That has not occurred yet. These things are in the future, and they're exciting, and they have exponential growth attached to them. And that's why Microsoft is spending $80 billion next year to win the AI race. Nobody has won a damn thing in the AI race yet. It's just a really, really, really cool technology. We got to win that race, not just from a corporate perspective, but from a country perspective. We are in a massive Cold War with China right now on both the AI side of the equation, semiconductors, intellectual property, drones, you name it, robotics, you name it. It's vitally important for us to win that race. Companies like Microsoft, companies like AMD, companies like NVIDIA, Taiwan Semiconductor, Google, Amazon, AI.com, C3.com, all these companies, they get it, they understand it, and the U.S. government does as well. That CapEx spending is not going to stop, Mark. In fact, I believe government spending will start increasing on this side of the equation under the Trump presidency. You have a big AI guy in Elon Musk that is all over this conversation.
Especially
there's once going to be an AI czar at the U.S. government. I promise you that. This is going to be a bigger conversation in the future, not a smaller conversation. People need to stop treating AI like a sideshow. This is a major, one of the most advanced, important technological advancements in human history that is going on in front of our very eyes. And so, yeah, I think it's silly that Wall Street embraces a negative CapEx spending when CapEx spending has done nothing but go up.
Yeah, it's especially going to get some government dollars once they figure out all those drones that have been flying around have been AI Chinese drones.
You read that story too?
No, huh? I freaking saw 3 of them outside my house the other night.
Oh, whatever.
No, I did.
I saw some UFOs outside my house too.
Honestly, I saw them. Okay.
All I'm going to say is don't shoot it, or Amazon's going to charge you with something. Okay, that's all.
They're there. I saw it with my own eyes. Saw it with my own eyes.
The Walmart drone that's dropping off the neighborhood.
Oh, these were not Walmart
drones.
Take it
out. That's all I'm saying.
These have some sparkle to them.
Technology in those drones is only, and I'm just going to say this. We don't need to go into a detailed conversation, but that technology in those drones. There's only 2 countries in the world that has that technology. It's China and the United States.
There's a reason I said China.
That's the list.
All right, give me URA, and then it will lead into our next story. One of the only areas that I felt comfortable selling naked puts on the way down on selling a tranche on URA, because I believe in the nuclear theme, the nuclear narrative. I think it is one of the best narratives I've ever seen in markets. It sustains itself. It creates. And you're leading to the ticker symbol, right?
Well, when you went URA, I already know the stock story.
Yeah, you know the stock story because you know what propelled it. Because we have seen it in multiple times in recent months. We've seen it with Mag 7, and on Thursday we saw the U.S. government awarding a $1 billion contract where Constellation will provide electricity to over 13 federal agencies. It is the largest energy purchase in GSA history. Nuclear, baby. It's real. It's a real thing.
Embracing nuclear energy here. Constellation, obviously a clear winner. URA got a nice little bid off that news that came out earlier this week as well. It's fascinating what's happening with some of these utility companies like Constellation. NextEra is another one that's doing some really good things. But energy the energy sector is not your grandfather, not your father, and it's not even what we grew up.
If you view utilities, you're not quite getting the story.
Utilities are not the twin sister of real estate any longer.
No, it's not. This is a different narrative. You're not quite understanding the impact of specifically the need for
you're not valuing the AI growth narrative.
Yeah, you're missing that part of it.
And it's a big part of the utility conversation. But Constellation, certainly a clear winner out of that U.S. government contract.
When you get the largest energy purchase in GSA history, General Service Administration.
You make the top 5 for the Trading Justice podcast, yeah.
You make Tesla in the news, not for the right reasons, actually showed that their total deliveries in 2024 showed a 1.1% year-over-year decline, right? This is Tesla's first annual sales drop in a decade. So
ever.
So Power rally candle on Friday, notwithstanding. That's not a good look. I don't care Elon Musk and Trump holding hands, as much as they want. That's a year-over-year sales decline on your primary product. So that's not a good look. I don't know how you spin it otherwise.
No, it is not a good look. And obviously there is some concern on that delivery number. There's no doubt about that. Obviously the market, sold off fairly aggressively on that. I just see Tesla right now as a lot of volatility, and without a clear directional edge anywhere right now. What I will say is that Tesla has obviously been going up like it's 1999, based on the fact that Elon Musk has a lot of influence over the Trump, incoming presidency. And when you're looking at, and a lot of Tesla has been a little bit of a proxy for that. Coming back to the technological side of Tesla, you're going to see some pretty interesting advancements in FSD, the full self-driving unit out of Tesla. That's one of their AI units. That's one of their very important growth metrics coming out of Tesla. You also start to see Tesla people to start seeing Tesla as that, battery producer and storage as well. So I have concern on the valuation side of the equation. Looks like Tesla's
why you have concern on that, because you're a sane
$14 billion PE ratio.
Because you're a sane human being.
Yeah.
Right.
But I would have interest in any deep sell-off on Tesla, but I don't have
fun trading stock. These levels from is anyone a long-term holder anymore?
In Tesla or in general?
No, in general. I'm just talking philosophically.
Yes, it still occurs. Yes,
I'll do stuff on Tesla. It's a fun trading stock. It's a fun trading stock. All right, where are we going to go next? Let's go to U.S. Steel.
Was that the third stock? Yep.
That was third. Let's go to U.S. Steel. Then we'll finish off with a sentimental favorite of ours. Let's go to U.S. Steel first, though, where Biden says, nope, I do not like that merger. And this one has been telegraphed by Biden for a while. And President-elect Trump also does not like the thoughts of U.S. Steel being purchased by a foreign entity. But Biden come out and said, no, like this deal is not getting through. This deal is not getting through.
I'm going to reserve the right to give Trump and the Justice Department some time when he actually becomes president. Because
now Biden came out and said he doesn't want the deal.
No, Biden said it last week, right? Yeah. Biden's I'm going to get the deal.
So Trump might come out and say, no, never mind, I like it. If Biden's against it, I got to be for it, right? That's American
And I've
policy.
also been seeing a lot out of conservative circles recently about this deal, specifically what it would telegraph to countries like Japan who want to invest in the U.S. And now the U.S. is making it extremely difficult for international money to come into the United States. That's an important point.
Okay, I'll take it back.
That's an important point, because one of the best benefits we have in the U.S. is our markets are sought out by, and our capital system is sought out by most countries around the world. We obviously need to. There's always going to be risks there, but we obviously do need to embrace that to a certain extent, right? I mean, we are the reserve currency of the entire world. And so like there is some debate there. We'll have to wait and see what the Justice Department under the Trump administration really truly believes about this one, because I'm not going to take an election cycle statement as God's word when it comes to mergers and acquisitions.
That is reasonable. Finish off with a sentimental favorite of ours, CHWY. Upgraded as a top pick by Wolf Research. CHWY is you always had a soft spot. Now, technically, this just gives us an excuse to talk about the technical chart, which is a pretty decent one.
Honestly, and it's been a really good one.
It's been a decent one for a while.
Yeah, this ain't the first time we've talked about CHWY coming from the low point. I feel like we've talked about CHWY quite a bit coming from the low point. This would be what I would describe as a mid-tier opportunity. And mid-tier opportunities can be really, really, really powerful. But mid-tier is, you're not coming from the ultimate low point, which means it's not a reversal. You're certainly not chasing momentum. I would say you have a mid-tier opportunity on the 35 breakout. I'd also say you have a mid-tier opportunity on the $40 breakout. And ultimately,
it's been very well behaved chart, Matt.
It's been extremely consistent. But in the short term, I just love this potential breakout at a 36. Yeah. Like I just think it's a really good breakout. And what was the bank that gave them the upgrade?
Wolf Research.
It was Wolf Research, but they also said it was not only a top pick, but like upgraded it against all the peers. Like they're very, Wolf Research is extremely bullish on CHWY.
Yeah, no, and CHWY, like one of the reasons it's been a sentimental favorite is we love animals in the Justice.
Americans love their pets.
But CHWY's had, CHWY's seems to have like a solidified place in the space, right? Yeah. In the space. And so,
yeah,
understandable why somebody would tap
CHWY's not, CHWY is not pets.com.
All right, I want to talk some questions from students in our little Coaches Corner.
Coaches Corner
podcast. Now, I have gotten a ton. Now, if you don't know, if you are new to Trading Justice podcast, I do the customer service for TackleTrading.com. Tackle Trading, team at TackleTrading.com is where you can reach me for customer service things. We like to have an experienced trader to answer questions because, we get all kinds of trading questions that can come in on top of that, and hiring someone to do that. Well, you just can't.
We've done that. It doesn't work. We like
so I do the customer service, and there have been a lot of questions come in because we have been launching the Tackle 25 recently, and so we've had a lot of covered call questions come in because a lot of people that are new to covered calls, and that's going to spur some questions, right? Because we talk with excitement about covered calls, and when you talk about excitement, other people are going to get excited and they're like, okay, I have questions on this. And so I've kind of taken a number of questions on covered calls and put them into a mesh of questions by that. And so I'm going to just start rattling. These are all on covered calls inspired directly by the launch of the Tackle 25, which Matt will be doing a coach's show on. First question. I'm a little confused, they say. To sell a call, do I expect the stock to go down like a bear call credit spread? Right?
No, we don't expect the stock to go down. You certainly could expect the stock to go down. That's your expectation on the stock is based on your technical read. Is it violating support and whatnot? When you sell a call against a stock you own, it's actually considered a slightly bullish to neutral position. And so you're not
because you own the
you're neutral to bullish because you own the underlying stock.
Whereas if I sell a bear call spread, I'm bearish because
you're just bearish. You do not want price appreciation. But in a clever call, let's take CHWY for example. Let's say you owned 100 shares of CHWY, right? And you wanted to sell a call option to bring in some cash flow against CHWY, right? And let's not do a 48-day contract. Let's just go to kind of that 34-day number. So let's just sell that call option to bring in some cash flow. Well, I'm selling that call option not because I think CHWY is going to go down, right? I'm selling that call option because I want to bring in some cash flow to offset the risk of the ownership of the stock. I'm bringing in some cash flow because I want to compound. I'm bringing in some cash flow because I don't think it's going to break out. I think I'm bringing in some cash flow because I think it's going to break down. I'm bringing in cash flow for a variety of different reasons, right? There's a lot of reasons why you would sell that call option. But to answer the question, no, you're not bearish. You do not need to be bearish because a covered call is a neutral to bullish trade. It's a neutral to bullish position. It makes money as the market goes up, not down. And so, no, it's not. You're not expecting it to go down like you would on a bear call spread, but there are other factors involved. For example, one of the more complicated situations on a covered call, and we'll talk about this in Tackle 25 Masterminds this year, but is when to not sell that call and allow the price to breathe a little bit and allow price discovery. Take CHWY, for example. I personally really like this breakout. I would not sell a call.
I would not sell a call today.
Yeah, because I think we're going to go up in price, right? And so there are expectations that are involved, and there's timing elements of when you want to specifically sell the call. But no, it is not a bearish trade. It's a neutral to bullish trade.
All right. Next question on this.
Can I say one thing?
No.
In bearish conditions, you will sell a lot more calls.
Yes. Yes. And I think that's going to lead into another question that I have. Next question is, when we sell covered calls, do we want to get called out from the stock? Is that what we hope happens at the start of the trade?
It depends. Are you position trading or are you investing in the company? If it's a trade, so trader versus investor, if it is a trade, then yeah, you do have an expectation to get called out. In fact, you're going to structure the trade to most likely get called out if you get price appreciation. So yeah, take CHWY, for example. If I was going to structure a covered call on CHWY right now, Mark, you could legitimately say, let me buy CHWY at 35.96 and let me sell the $36 call option, bring in $200 of cash flow on that. And you would say, okay, well, why would you sell that one? Because I don't want growth. I want to get called out, right? I want to get called out. So if I wanted to get called out, hell, you could even sell an in the money call option. You could structure a covered call to get called out, no doubt. I've actually taught a lot of new students who have had investments in their life for a very long time. They've owned XYZ company for 10 years. They've owned ABC company for 20 years, but they've never cash flowed on it. And they wanted to get out of the position because it was just something that was in their longer term portfolio forever. They never really looked at it. And so they would be like, let me just go dump my stock. Let me go dump my stock. And I would say, okay, you can certainly do that. But why don't I show you how you can sell something to get out of your stock? And let me sell that in the money call option. And if it gets called out because price goes up, if it gets called out, well, you get out of your stock and you get paid $250 to get out of your stock. And so it really goes at what you're trying to accomplish. And so in a trade, in a boomerang, yes, you are structuring the covered call to get called out because you want to get called out. You want to reduce your exposure. You want to get called out so you have more capital to allocate to another trade, whatever the case might be, but you want to get called out. Boomerangs specifically are based on getting called out. But if it's an investment, then you're not going to structure the covered call to get called out every single month. You're going to give up some of that cash flow and say, let me bring in a little bit of cash flow, say 50, 60 bucks. Let me bring in a little bit of cash flow, only 2% ROI. But if the stock goes up to 41, I'm not going to get called out. If it goes to 38, I'm not going to get called out. If it goes to 39, I'm not going to get called out. So I'm going to structure that a little bit higher. And so the covered calls are very, very flexible on what you're trying to accomplish. I've known a lot of longer term investors, for example, that will sell 3 months out because by selling more time, they can sell deeper out of the money, bring in their cash flow, but they never really have to worry about it. So it's really specific to you as the trader. But yes, in certain covered calls, you structure it because you want to get out. That's the trader in me. And there are certain ones that you structure to not get called out. That's the investor in you. And so it really depends on what that stock's purpose in your portfolio is.
Next question. Love these answers, by the way. Love these answers, by the way. I keep looking for points to interject, and I'm like, no, I agree with that. I agree with that. I agree with that. Well, next question. What are the key points to remember for trade management of a covered call? When should I expect to make hard decisions?
Oh, the hardest decision in a covered call is when the stock goes above the strike price.
I loved that question when I read it from someone. I was like,
that is the hardest decision you have to make. Because there's two base ways you manage covered calls. You manage top side, downside, right?
Yep, top side, downside.
You manage the top side with the strike sold. So if you sold the 38 call option on CHWY, for example, your decision you have to make is above 38. If the stock price goes above 38, you have a decision to make, because if you don't make the decision, the market might make it for you. And I would rather have you have that control over that decision than the market have the control over that decision. Now, if it goes from 36 to 39 or 38.01, the market's not just going to call you out. Obviously, I'm about ready to start teaching the Tackle 25 system. Definitely check it out. I go through it in quite a bit of detail on the management side of the equation, but you manage the top side first, and that's the strike price. And that is the absolute hardest decision you have in a covered call, because you're ultimately you're covering the risk, right? By pulling off the call, you're in essence pulling off your hedge. And you're making the decision to open up the risk graph and allow price discovery. Well, price discovery can go both sides of the equation, up and down. And so if you're right, fantastic. If you're wrong, you just lost your hedge. And so that is a difficult decision to make. There's no doubt about that. But from the mathematical equation of implied volatility implied volatility, I'm having a little bit of something caught in my throat here. Intrinsic volatility versus intrinsic volatility, you can understand when you can get called out. And so that is the absolute most difficult decision to make, is when the stock goes above the strike price. On the downside, you're managing net liquidation value, and quite frankly, that's child's play in comparison to the other one.
Yeah, Matt and I were having just a genuine, like, just we were just talking one night, and I don't know how it came up, but we're like, if you can manage upside on cover calls, that's then you have them down. Like, we were just, upside. Next question. What should I do with the cover call income? Should I reinvest it in the same stock, or more shares, or look for another stock, or do something else with it?
Well, the year of 2025 is the year of cash flow at Tackle Trading, because we want our entire community to start embracing the compounding impact of cash flow. And the question of what to ultimately do with the cash flow is obviously a personal one. What I will say is, take your significant other out for a nice little dinner date. Make sure your life is fantastic. Make sure your retirement is taken care of, your children, your family, your legacy, all that jazz. But to do all that jazz, you have to compound back into the stock. And so I would say, if you don't have core positions that you anchor against, a core stock that you own, pick a stock, start cash flowing it, and compounding directly back into that stock. Work on your core positions in 2025 if you don't have them. And with a question like that, I'm assuming they don't have them, because if they did, they would already know the answer to the question. And so work on your core positions. Pick 2, 3, 4, 5 stocks. Start compounding cash flow back into it, the gains back into those stocks, because I call it the race, Mark. The race is not a cash flow race. The race is to the next level in an option trade. And what I mean by that is, if you do like 100 shares of a stock and you do a cover call, well, if you never compound, you're always going to do 100 shares, 100 shares, 100 shares, 100 shares, which means you're also only selling one call option. Well, let's say you owned 200 shares of CHWY instead of 100 shares of CHWY, because CHWY was one of your stocks you picked last year. It was going to be a core position. You compounded into the stock all year long. And now going into year 2, instead of 100 shares, you now have 200 shares, because you compounded back into the stock. You took the cash flow, you bought more shares with it. Now you're going into year 2 and you have 200 shares, and you can sell 2 call options, which means you're doubling your cash flow, which means you're doubling your compound rate, which means going into year 3, you don't go from 200 shares to 300 shares, you go from 200 shares to 400 shares. And so the compounding impact is vitally important. And so I would make the suggestion to work on your core holdings, and then once you get those dialed in, then you can get a little bit sexy.
Yeah, listen, I've enjoyed this podcast, brother. You got that coach's show Tuesday night, in which you are going to be talking a lot more about cover calls, and talking a lot more about cover call candidates, and answering questions, I am sure, from our pro members. But we also answer questions in the Traders Lounge Monday, Tuesday, Wednesday, Thursday. We call it team time. We are educators. We love the markets. We analyze it. We take the macro, but we are educators. As we apply, we welcome questions. Come be part of that pro membership. Matt, give us some final thoughts. Send us out.
Yeah, the next couple weeks at Tackle Training is going to be way fun when it comes to the covered call side of the equation. The next two coaches shows we'll be going through the Tackle 25 together, the scoring system, and answering all of your questions. No doubt about that. That's what the great community of Tackle Training is all about, taking the application, marrying it with the education so that you are your best self as you navigate the financial world. And with that said, if you want to support the podcast, best way to do that is hit that like and share button. Tell somebody about the good message of trading justice. And I hope everybody has a wonderful, wonderful, blessed week. And if you need anything from Tackle Trading, you can always hit us up at team@tackletrading.com or in our Discord channel as well.
Have a great week, everyone.